Hello, I'm Jay Hurst, Director of Administration of Columbia's ERM program. I'd like to welcome you to today's presentation on banking turmoil, how to prevent the next bank failure. Just a quick disclaimer, the opinions expressed by the panelists are their own and are not necessarily those of their companies. During the event, please post any questions you have using the Q&A feature at the bottom of the screen. Questions will be answered at the end of the event. And now I'd like to introduce today's moderator, Bob Kostakopoulos, Deputy Program Director of the ERM program.
Greetings, everyone. My name is Bob Kostakopoulos, Deputy Program Director and Lecturer. I'm very pleased to and honored to be the moderator of this very important panel. As you know, panels are important co-curricular activities in the program that are valued very, very highly by our students. And our students, dear panelists, are grateful to you for doing this. We'll start by having each panelist introduce themselves in alphabetical order. And Didier, you are first. Please go ahead.
Hi, everyone. It's a pleasure to be there as well, even if virtually. So I'm Didier Blanchard. I'm the head of enterprise risk management for the Americas for Société Générale, so the French bank. Which I've joined after a career at French regulators and at its rival BNP Paribas.
Okay, Benoit.
Hi, everyone. I'm Benoit Daucher. I work in liquidity planning and coverage and mainly running the firm liquidity stress testing at Morgan Stanley. I've been working in liquidity risk management for over 10 years.
Michael.
Hi, everyone. I'm Mike Liebrock. I'm currently Managing Director at DTCC in Jersey City, responsible for counterparty credit risk and systemic risk. And I'm also a lecturer at Columbia's ERM program.
Chris.
Hi, everyone. My name is Chris Mann. I'm a Managing Director in credit risk at US Bank. I was at Mitsubishi Bank before my team was bought by US Bank. I'm also a lecturer at US Bank. I do credit risk, stress testing and underwriting models. And I'm a lecturer at Columbia. I've developed a class with Mike and two others, one myself and helped somebody else develop one.
Okay, I think Chris has a small deck that he wants to share with us as we begin the panel. Chris.
Okay, so to me, everything is context. And so far, everything we see in the news basically just says that these banks are outliers and they might show one or two other reference points. And I thought it would be nice just to show a few slides that put everything into context and hopefully dispels some of the rumors that we might have heard about why things happened. So on all of these charts, the horizontal axis will always be total assets. The nice thing about that is I show all the top banks that have at least 500 employees, which kicks out a lot of odd banks. And in this chart, you can see uninsured deposits because that's the big topic today. And up on top, you can see the 5-year path for Silicon Valley Bank, Signature Bank, and First Republic Bank. And the first thing that jumps out is that Silicon Valley Bank really was an outlier. They hit over 90% in 2021, and by the end of 2022, they had come down, but they were still well above most other banks. The only other bank that was anywhere near them was Signature Bank. I have First Republic here because they're often in the news. The median is much lower. It's about 39%. Over on the right-hand side, those four banks are the four big money market banks, money center banks, JP Morgan, Bank of America, Wells, and Citi. So you can see basically we expect most banks to have some uninsured deposits simply because they have to deal with large corporations. Next slide, please. What this is not a story of, it's not a story of bad loans. This is not 2008, 2009, 2010 all over again. You can see, and I didn't put the 5-year history, it wasn't really that important in this slide, but you can see down there near the bottom, all 3 of these banks have hardly any charge-offs over 2022, which means that they did not experience any distress in their loan book. Signature Bank was right on the median. The other 2 were below the median. And just so you know, of the 3, Signature Bank and First Republic Bank are primarily residential mortgage lenders. Only Silicon Valley Bank does more commercial, and they do small business effectively. Next slide, please. And this I found very interesting. I noticed Silicon Valley Bank several years ago when I was trying to understand how banks staffed themselves and paid themselves, because they have always been the bank that basically provided the fewest staff to cover the most assets. So the vertical axis in this point is the number of people per $1 million in assets. Right? So the median, I think, was 0.12, which means that most banks will have 1 person for every $10 million in total assets, right? And you can see there's a trend. The smaller banks have more, but the money center banks have a reasonable amount. But if you look at our 3 banks, all 3 of them are far at the bottom end. They are outliers. They have underinvested in staff. I don't know if there's real reasons for this, but I guarantee that there's other banks in this group that have business models very like theirs that have more staff. So I would say just superficially, they probably could have done more. Next slide. But this one shows how much they pay their people. The nice thing about the call reports that the Fed puts out is they put out total salary and benefits. You can divide that by the number of full-time employees and find out how much people are being paid. And that praying mantis sitting there in the middle is our banks that have been in the news. They all pay themselves well more than any other bank. There is one bank over there to the upper left. That is a private bank that deals with a small set of families. So I don't know anything about it, but they've got their own story and they're not showing any of the other signs that we have here. If these banks paid themselves less, like say they only paid themselves on average $200,000 per employee, each of them could have hired a couple of thousand more people to maybe model deposits better than they have, or model interest rates better than they have. So I'm not going to say that these were mismanaged banks. Everyone else is saying that, but these numbers superficially say that something's not quite right here. So that's the context. This is definitely an uninsured deposit issue. It's not a credit issue, and it might be a management issue. So that's what I have, Bob.
Okay, thank you so much. So we'll start then, given the context that Chris gave us. The first question that we have is, how did the failure of the 2 mid-range non-systemic banks, in SVB and Signature Bank, endanger the financial system's stability? And we'll go to Michael to start us off. Michael?
Sure, Bob, thanks. So as you said, neither bank was officially designated as SIFI or systemically important financial institution. However, their failures did have a significant impact, in several ways. SVB was approximately the 16th largest bank in the US with over 200 billion in assets, and the largest bank failure in many years in the US. So this caused immediate widespread concerns about the global banking sector. For example, during the month of March alone, the top 25 US banks lost the combined 300 billion of market cap. It also led to widespread fear of additional deposit runs at other banks, similar to what happened at SVB. This also led to concerns about other banks that might have counterparty credit exposure to the banks that failed. Again, a concern about a contagion risk. Fortunately, to date, these failures have not led to a systemic banking crisis. I think there's a number of reasons for that. Just a couple of them I'll point out from my perspective is that shortly thereafter, the failure of SVB, the Fed and Treasury issued a joint statement assuring SVB depositors that they would be backstopped by the government. And also the Fed created a special liquidity facility for the US banking sector to alleviate funding concerns. There are other reasons, but I think, from my opinion, those were at least two of the reasons that kind of stemmed the concerns from depositors at other banks from running and pulling out their deposits, as would happen to SVB and Signature.
Okay, so Chris or Benoit, anybody else wants to chime in?
I'll jump in. I mean, I'm not going to say anything surprising, but this has caused a lot of people to move their money out of banks, especially the uninsured deposits, into money market accounts. And that's causing, I mean, that's one of the reasons a lot of banks, especially smaller and regional banks, are starting to curtail their credit. So we're seeing some credit tightening going on. So that could lead to some, that actually could be a precursor to a recession, could lead to some financial instability outside of the banks.
Okay, so Benoit or somebody else?
Yeah, I'm not sure if the transfer over to money markets or CDs was driven by SVB, or if it was just a pattern based on the high inflation and people seeking higher returns. But yes, altogether, I think for what we described, all these liquidity stresses or risk is driven by loss of confidence. And so this is what you want to control as quickly as possible to prevent the panic to be spread. So
yes, and we will see as we progress here with our discussion, the regulatory response that Chris alluded to, and Michael, was quite quick and drastic, and that may have had something to do with the stopping the contagion from expanding. If we don't have any other comment on this question, I'll proceed.
That a little
Yes.
thing, and probably about what we're always telling students about systemic risk. We usually say it depends on the size of the institution that fails. Actually, I think it has proven it wrong. We usually when we study systemic risk, we look at how many interbank loans there are, how big is the size of the institution on the markets, and how much is going to be the direct financial impact. And here, what we're saying is, well, the impact was like not zero, but manageable. Actually, what we saw here is systemic risk through market panic, market contagion. What if there was a lot more to come? What if this was only the first of the dominoes? So basically, this brings us to revise completely the way we see systemic risk, and we calculate it, at least in academia, and probably we would do well to do it in banks as well.
All right. So that leads then to the question of what caused the failures. I know Chris alluded to certain things, but what is the story here?
I'll kickstart that. Actually, this question was interesting. There were so many things, and when you look at various sources, you find a lot of different elements all concurring to it. So I'll focus on SVB because SVB is the absolute emblem of that kind of thing. I believe that Signature, for example, it's fewer causes. It's less clear as well. So I would classify the causes of what happened to SVB in several buckets. first one, and remember, I'm an enterprise risk manager, so I'm always going to come to this governance. Well, there was a massive, massive problem with governance. So everybody said no CRO for 8 months. That was one thing. Board meetings. So they had 18 board meetings actually in 22, which seems very impressive. So you would say they're super well supervised. When you look at the qualifications of the board members, they're quite fun. Actually, there was absolutely no expert of risk management of any sort in their board. Then when you look inside the bank itself, it was a playbook of the mistakes you shouldn't be making, maybe because there was no CRO. For example, the IRBB models, that's the factor that caused the default. Gave figures that the CEO and CFO didn't like. No problem, just change them. So just a figure for everyone. They had made simulation of what would happen if the rates were hiked by 200 bips, and their model said, well, the economic value of equity will fall by 27%. I think this was even very optimistic. And CEO said, I don't like it. So the committee brought it down to minus 5%. So that's if you work in ERM one day, don't ever do that or let that happen. Then, of course, they mismanaged the risk. Second obvious cause, for example, they did not understand at all that their deposits were not sticky and would go away, or that it could interact with the interest rates position. They even got to sell their hedges they had against the interest rate increases at the fall of 2022 for a profit. So they were completely unhedged, which is also something that's very atypical. So that's, and we'll come back to the regulatory causes and what the regulators knew and did or did not do later. I'll add one thing to what led to this. There might be more to it than what we've seen. In particular, regulators are still investigating the question of why the CEO sold, I think it was like 3 million shares just before announcing the need for a capital raise and selling securities at a loss. So there is probably more than bad governance, but also probably misconduct as well.
Yeah, conduct risk, of course, is one that we study in operational risk management. So IRBB that Didier referred to is a regulation, if you will, interest rate risk in the banking book that every bank had to comply with starting in 2018. And but you saw what happened. They did not accept the results of that metric. So nobody knew that their liquidity situation was so bad. Any other insight from our panelists?
I mean, I will say that I think that the proximate causes of the customers relying on using their deposits to make payments instead of taking more loans, the moving some for sale treasuries to the hold to maturity book to avoid having too many short-term markdowns. All those are normal practice. So those were easy to see by the board and by the people doing the modeling. I still find myself surprised that the executives saw what was coming from those modelers and didn't like it, even though these are just business as usual type topics. So I do think there was a severe breakdown at the top in terms of understanding these things.
Yeah, back to the governance issue that Didier referred to. Yes,
exactly.
Maybe just a couple of things, Bob, I'll add briefly is the firm grew very rapidly. I think Chris alluded to a couple of data points earlier, but their total asset size grew from something around the $50 billion range just a few years ago to over $200 billion when they failed. So they clearly, didn't manage that growth well. And Didier referred to the non-sticky nature of the deposits, which was, a key point, was also concentrated by industry. Apparently, the technology industry represented the lion's share. So you have them flee, and it's kind of led to a contagion within that sector. So lack of diversification in deposit base as well.
Yeah, I think Michael is hitting on the growth, fast growth. Fast growth is a metric that the regulators monitor. If it exceeds a certain percentage, then they really come after you. So it's a red flag. In other words, growing a bank very quickly is
Yeah, and for those of us making bank default models, bank growth is definitely one of the factors we look at very closely. Anything above organic growth of 5 or 10% per year is definitely a sign that they will probably overextend themselves.
And just one figure as a result, in one day, $42 billion of deposit exited SVB. So that's something even for a much bigger bank. The figure is astounding.
It is absolutely. So the next question has to do with the whether or not what happened to those banks had anything to do with the fact that in 2018 there was an amendment to the Dodd-Frank Act of 2010, where the regulations were relaxed, and those two banks in particular lobbied the Congress very, very, severely to get that amendment in. So they increased, in other words, the threshold for 50 billion assets to 250 billion assets. So if you are now 250 billion assets or lower, you're subject to more relaxed supervision by the regulators. So I'll see if Chris has any comments on this.
So there's not much to say here. I'm hoping that maybe Didier or somebody else supports, but my view, and I think it's a widely held view, is that there really was not much that, even if those thresholds had been kept where they were, they would not have caught these banks, right? So the Dodd-Frank was looking for credit weakness, not really liquidity weakness. It does have some liquidity management in there, but that would have tested out just fine because of the way they did it. We found that the weakness was that instead of having modeling around deposits and liquidity, instead you really had, you have modeling that was required to forecast outflows, but then they just used haircuts on the different classes of securities. So the treasuries that they held, even though they held long-term treasuries, which were not in this market very liquid, those had no haircut on them. And they're part of what caused the trouble here. So I know that the management at SVB and Signature both talked about how it was the relaxing of that regulation that convinced them that they could increase the sizes of their banks. But in the end, whether they did that because the regulation was adjusted or not, the regulation had no real effect in this situation, I think.
So, and I will, as you said, rebound a little bit on that. I would agree with you. Everybody focused on the LCR and NSFR, sorry for the acronyms. Those are the regulatory liquidity ratios that are imposed on banks and that were imposed on those banks before the relaxation of the rules. Actually, when you go a little bit further than what you just find in the first newspapers, the 2018 reorganization of regulation came with a little bit more. And there's something that people didn't very much look at. It's called AOCI. So it's an acronym that stands for Accumulated Other Comprehensive Income, and it exempts banks from category 4 and 5 in a way, other firms. So category 4 is the category to which SVB belonged. So the smallest category. It exempts them from impacting their regulatory capital with AOC, and AOC is the impact of their AFS, available for sale securities, notably. So an interesting thing, and believe me, this one really led to the problem we saw. So basically, and it's really not well known by anybody, bigger banks have to do like everyone else. They have to impact their own funds with the unrealized losses or gains on their AFS securities. Those banks don't have to. So what happened with SVB is basically, as you know, those AFS securities, as well as their held to maturity securities, quickly lost value as the rates went up, but they didn't have to impact their capital ratio. So I saw a lot of analysis where they said, well, they had very great capital ratios. If they had impacted AOC, I can guarantee you that this would have raised a lot of red flags because
I have a question for you. Was that part of the 2018 adjustment, or
Yeah.
is that longstanding?
No. It's part of it. It's part of the tiering, actually. So if you move to category 3, you have to impact AOCI. So
no, the question was that part of the original Dodd-Frank, or was that adjusted in 2018?
It was adjusted. It was
Okay.
so everybody had the same rule, and so they allowed up. It's exactly called allow opt out of AOCI capital impact. And before that, you simply couldn't do that. So for that size of bank. So interestingly, that one was more effective than the very visible liquidity ratios. So there are other things that could have happened. For example, they stopped having to produce the qualitative analysis of CCAR, but and the single borrower exposure. Okay, they didn't have any credit problem, but imagine a bank that would have had one. Probably it would have slowed down the response from regulators. Now I have a second layer on this. It's actually, do the regulators, the supervisors, need this to intervene? And that's the second question, because people think it's black and white. Regulators or supervisors are, if they have a ratio to intervene, they're going to intervene. If not, they're going to be blind. Actually, I have one thing to say: they weren't blind at all. If you look at the time series of their actions to SVB, they issued 6 MRAs, MRIAs. It's public. Just to say, I have strictly no private information on this. Disclaimer. So it's all in the press. In 2021, the Fed issued 6 MRIAs that were like pretty stringent. They caught them then on a horizontal review. They had put them on notice. So they knew. Actually, this had also been found by BlackRock Financial Markets Advisory in 2020. They had said you're below your peers on everything. So there were external actors that knew. However, so the question that will be unresolved until May 1st is, would the full regulation have allowed them to work faster? It's true that if you have a ratio, maybe you'll save a few months of analysis and wondering and issuing MRAs. Second thing, was issuing MRAs and then moving slowly to the next step fast enough? So definitely, probably not. Should they have moved faster to consent orders, cease and desist, and anything that would have really stopped management from doing that, or even dismiss the board? Remember, they did it for Wells Fargo. They dismissed half of the board after all, but that was a compliance issue that was very different. So just for everybody's knowledge, you know that the Fed promised that they would investigate their actions with SVB, and they are supposed to issue their report on May 1st. So it's almost too bad that we didn't have this panel after May 1st, because I believe we will have a ton of things to review. So
Yep, and there's another.
So I'm sorry, I have to jump in here, just especially for the younger people in the crowd. So in the banking system, if you get an MRA, which is a matter requiring attention, you do everything possible to clear that out very quickly. The next step up, if you haven't cleared out your MRAs, the Fed or the OCC, well, no, the Fed's the only one that does the MRAs. they get mad and they issue an MRIA, which goes directly to the board. And usually the board is often given 4 weeks to respond with a plan for resolving the issues, and basically told if they're not solved within a short period of time, usually 6 months to a year, that business will get shut down. I agree with you that the Fed might have been moving slowly here, but SVB, I'm just stunned that they did not react to fix these things where, I mean, when other banks get MRIAs, they will spend tens of millions of dollars. Even small banks will spend tens of millions of dollars to fix them and make them go away. And they just seem to languish there.
My view is that's multi-layered. So if MRAs and MRIs fail to reach their goal in a given time, there are lengthy discussions about what did you do that. And then they start preparing the next step. Probably, my view is they were going to do that, a kind of cease and desist consent order or anything, but they allowed SVB to go very late on those MRIAs, and they defaulted before they could get done, probably. We will know,
so
actually, I'm speculating, we will know in a few days.
Right. The next question has to do about the regulatory response. I think we heard about DDSA that the regulatory response was not the best it could have been as far as enforcing those MRAs, the matters requiring attention, as opposed to just sending them out and then waiting for them to hear back from the board. So, but do we have any more insights in terms of the regulatory response? We know the Fed, I think you mentioned, our panelists mentioned that they opened the, Michael, I think, liquidity gate, and banks had access to liquidity, so they could fund the deposit withdrawals without having to sell assets in this environment. And also you also had the industry stepping in to help the liquidity needs of First Republic, for example. This is one of the reasons that bank is still around. But any other ideas, thoughts about the regulatory or characterizations of the regulatory response?
Well, they're not a regulator, but the role of the FHLB, the Federal Home Loan Bank System, played, I thought, was critical. I believe they provided roughly $800 billion of advances to their member banks rather quickly, which I think was an all-time record or something close. So I think it was a combination of factors that helped kind of stem the crisis, because providing all that liquidity to the banking system or to the individual banks allowed the banks not to have to sell those assets and securities and realize those unrealized losses that could have caused more SVB-like situations.
Yes, that makes sense. So anybody else wants to chime in on this?
Maybe we can mention the FDIC. After all, they're taking ownership of the banks, and finally they're promising to insure well beyond their normal threshold. So I'm definitely not a specialist on that part, but it was one of the main discussions on the street about how to reassure the market that the consequences wouldn't be big.
Yes, so you have a very well coordinated effort, right, by the Treasury, the Fed, the Federal Home Loan Bank System that Michael mentioned, and also JP Morgan. JP Morgan led that league of banks, 11 altogether, to put some unsecured deposits, uninsured deposits into the First Republic Bank as a show of confidence that the bank is safe, and they're willing to risk $30 billion by depositing uninsured monies there. So, all right. The next question is, what lessons can be learned from the current banking turmoil? Benoit, you had a perspective there from a historical.
No, but there was an interesting article a week ago, I think, on Bloomberg, quoting some of the comments from the CEO of JP Morgan. Apparently in 2008, his daughter was asking, what is a financial crisis? And he just responded, something that happens every 5 to 7 years. The journalists continue to say, I think it was the journalist himself, not Jimmy Dimon, that the financial system is something that is kind of fragile, and so as soon as you have a loss of confidence, that is going to create a turmoil. So that is something that probably should be expected, and here it was just the question of the large loss. There was an article in the journal mentioning that SVB quoted in their financial statement that in a footnote that were they to report the mark-to-market of their held to maturity, they would have reported a loss that was greater than the equity. That's probably what triggered the run on the bank. But that's really all these little details, and any imbalances will create a potential problem of panic.
Mhm.
Chris?
So just add, Bob, to that.
Yes, Michael.
The role of technology in recent years, right, has allowed all of us to do our banking much more efficiently and quickly on our phones, and Twitter and other tools allow folks to communicate more quickly. But I think what we saw happen with SVB is that the downside of all those advancements, right, led to deposit outflows happen, billions of dollars within minutes. And that's something I think that, going forward, it has to be solved for somehow. It's not easy by any means, but I don't think there's anything today stopping this from happening again, right? If there's a rumor that started, for example, around another bank that may or may not even be true. So I think the role of technology and how things are just different today than they were 10, 20 years ago can cause future bank runs.
Absolutely. The response, the speed of getting a transaction through. This is why I think here the mitigation is those circuit breakers, which I know the exchanges used on some of the stocks of the affected banks, because the trading was so heavy. People were trying to unload their shares of the banks that failed, and trading had to stop on a number of occasions because of the amount of reduction in the value of the stock, so that is, and of course you have you can. We say that had they done the things that they were supposed to do as a bank, right, that maybe they would not have gotten to this point, to the point where they failed. All right. So in terms of what sort of changes may be forthcoming as a result of the turmoil that started with, in the first part of March, three banks failed. One is in self-liquidation, the Silvergate bank, but the other two that are the subject of our discussion are they're giving us a lot of good information in terms of what sort of changes might be required down the road. And we know, for example, that the FDIC is going to be issuing an advance notice for comments for new proposed regulations. And they would be addressing, some of the things that they are going to be changing. So that's another way, another reason we have to wait till May 1st. That's when they'll publish it. But Chris, in terms of the any forthcoming changes, to prevent bank failures?
I mean, there's going to be a lot, hopefully, that comes from this. I am concerned about the idea of increasing the FDIC insurance because that's paid for by the banks. I mean, you saw that, what is it? Probably half of the deposits out there are uninsured. I'm hoping that that's not just money sitting there being parked. I hope a lot of it is for day-to-day business at these corporations. That would require a significant increase in the insurance premiums going to the banks. And I think there's going to be pushback on that. But I do think that we need absolute confidence in the financial industry. So that's one way to go. There's also going to be a lot more pressure from the Fed to look at liquidity management a lot more closely. And I will expect the Fed to put out guidance, which is much better than just putting haircuts on different types of securities. They're going to expect much better modeling. There's going to be better controls about when things move from assets for sale to hold to maturity. Because, I mean, they were trying to hide their losses on their assets for sale by pushing it to hold to maturity, which a lot of banks did. It's good, but it's not necessarily the best business model. So I'm given that we're getting close to end, I'm just going to cut at that point instead of going off on a rant.
Okay, so that's excellent. Comment. So let's see. Anybody else sees anything coming down the pike?
So, well, we'll know a lot more in 10 days again. So we're trying to guess what the Fed will come up with. But the first thing I would say is it demonstrated that regulation and supervision are not the first line of defense. And that's really important for me. This is a failure first of governance and risk management in SVB. I mean, it's egregious. It's the bad behaviors and the bad practices here could not be avoided. I mean, having no CRO at all, overriding models. I've seen another report that they completely ignored cybersecurity concerns that were raised to them because it's costly to mend. So maybe if they hadn't failed because of that, maybe the SVB clients would have all their data exposed today on the dark web. So basically, that's the first line of defense, and the supervision needs to stay concentrated on that and maybe be a bit less tolerant for material deviations from that. I don't know how they can address that, but it's a real point. The second will be how still in supervision can they accelerate actions in case of imminent danger? How can they go faster and stop management from a bank from doing what they're doing? And the third one will be, of course, what everybody's expecting. They will look at this change in Dodd-Frank done a few years ago and look if it could be better. But in my view, it shouldn't be the main objective here.
Okay, so better supervision, more consistent supervision, not necessarily new laws or regulations. In terms of in the aftermath of recent events, what is the outlook for the banking sector over the next 6 to 12 months? Michael?
Sure, I can start off and others can chime in. I mean, I'm fairly bearish at this point. Actually, there's a lot of headwinds even before this crisis happened. But now you layer in the fact that it's likely that banks will be facing new enhanced regulations, right? The ones that are less than 250 billion in assets. That's something already being discussed. I believe that's going to lead to increased regulatory costs. Also, because we're seeing billions of dollars of deposits start to flee the banks, as someone mentioned earlier, for money market funds where folks can earn a higher yield with arguably or sometimes less risk. The banks are being forced to pay up now for deposits to keep those deposits. That's going to compress their net interest margin. So I think, those are a couple of significant, headwinds that might impact bank profitability, not to mention the looming potential recession that might be out there.
How about the migration of liquidity risk into credit risk as interest rates are where they are or may go higher? There's talk about the commercial real estate sector as being exposed here because a lot of those loans are coming up for renewal and need to be funded, and banks may be shying away from advancing credit. Is that something that darkens the horizon in your view?
I mean, we're already seeing credit risk going up in the auto and mortgage sector. Commercial real estate obviously is a significant weakness. Rollover financing risk, as you said, is difficult. So as loans come due, instead of being able to refinance, they may not be able to. So you're absolutely correct with that. I think everyone's watching that very carefully in the bank space.
So that's there's a lot of uncertainty about that. Didier or Benoit, any insights on what may be happening in the next 12 months in terms of outlook? What the outlook is.
I think this was maybe more of a distraction somehow. So you have a market parameter here, the interest rates going outside of the historical ranges that we've seen in the past years or decades. You always get somebody wrong on this. I can guarantee you. Like I have a memory of 3 years ago when dividends were not paid by firms because of COVID, and suddenly everybody who had equity derivatives on a bit exotic on dividends suddenly started making nice losses. Well, it always hits somebody. There's always somebody who's not prepared when this happens. But interestingly enough, it hit 2 banks of not so big a size in the US. Didn't touch anyone else. Credit Suisse, I believe, is extremely idiosyncratic history linked to their own story, and it's not anything where I would say, okay, all European banks or Swiss banks are affected or anything. So I believe that once the distraction is over, we will reconcentrate on something, the cycle, and whatever it brings to banks, meaning good old credit losses, market shocks, liquidity tightening, and everything. We shouldn't get distracted by that. That's probably what the future has for us. If we enter a recession, this is a much more serious story as usual. And sorry, it's boring, I know, but it's probably what we still need to keep looking at.
Okay, I was looking at some numbers this morning in terms of what the yield curve is doing. It's still inverted, which is correlated with a potential a recession down the road, and also the implied inflation rate, expected inflation rate over the next 5 years is at 2.3%, and which is quite below what the current inflation rate is, which is about 5%. So that's another indication that that's because the markets maybe expect a slowdown or a recession, but who knows? So any other thoughts here, or we can move on to the to a question that maybe helps analysts, risk analysts, and to assess a bank's financial condition. What sort of key risk indicators we might employ to give us an ability to assess the condition of a bank. Michael?
Sure, I can start off, Bob. So I think one of the interesting things about this particular crisis, I think it was mentioned earlier, is that it was sort of in plain sight, right? The risk factors were pretty clear, or should have been pretty clear on SVB's balance sheet, unlike some other prior crises that maybe were in some esoteric asset class like CDOs or some sort. So to the extent that bank analysts aren't already doing this, there's probably a couple of pretty simple metrics early warning metrics they could use, such as total uninsured deposits to the total deposits that are greater than some percentage, whether it's 50%, 70%, just to be kind of a red flag for maybe this firm is now taking a risk, has a risky funding structure. Could look at total unrealized losses to equity, which again, someone mentioned before at SVB, I think their unrealized losses maybe exceeded their equity or close to that. That would be a pretty big red flag. I would just stress that, from my perspective, no one metric really should be looked at alone, because a bank could have 80% uninsured deposits, right? But if they have otherwise excellent capital and management and risk controls and liquidity, then maybe that could be managed. I think in this case, the firm had multiple issues at the same time, but those are just a couple of ideas.
Okay.
Yeah, you can include also concentration.
Yes. Yes, go ahead.
It's a standard metrics that you have on the concentration. So yeah, you can have large deposits, uninsured and so forth, but what matters is how these deposits are being used. So if the uninsured deposits were here and they were just sitting and not funding any assets, it's probably not necessarily a material risk. But here there was no other source of funding, material source of funding, highly concentrated, and with the risk of loss relatively high due to the high level of uninsured deposits used to fund assets that lost values. No hedging on the rates.
Unfortunately, the most important thing which Didier kept talking about is the hardest to measure, which is knowing that there's an effective set of controls and risk management. And that involves being much more closely attuned to the banks, right? As Mike said, you could have uninsured deposits of 70%, but still be doing quite fine. It's all whether the risks that you take are well managed internally. You've created the processes for forecasting and pay attention to the red flags.
All right. It looks like we have a number of questions, so in the Q&A, so it might as well jump in that direction. Okay, let's see. So since 90% of SVB's and Signature Bank's deposits were uninsured, it suggests that the bigger deposits per customer. Okay, it is natural that the employee per 1 million deposit is low there at the bank. So Chris is saying here, Chris, because you addressed that, that may be because of the fact that you had a lot of people with big deposits, which is true. I heard that someone had a $10 billion checking account, from the tech companies. But so I'll give you a chance to respond to that. Does that justify that they had so little personnel per asset?
No. So that's a great question, Chris Cruciotis. I actually was starting to look at that. The only information I do have the number of depositors. I don't have the number of loans. I'd like to look at both sides, but I was gonna look at that next. It all comes from the Federal Reserve Board call reports. That answers a different question. Once I have that, I have your emails, so I will share with you what I find, whether this makes sense or not.
Okay, let's see. We have another question here about as this crisis management was bad as well. So it's not a question. Someone is adding to the conversation as to why that bank failed as well, and that's fine. Then we have it's as risk managers or managers or regulators, it's very difficult to go. Let's see what happened to the question. Very difficult to go to the bank management and question the performance. It's a question mark. Is it difficult for regulators or a risk manager? Right. If the risk management function, I guess, is independent, then the risk manager can go to the executive team and speak to the problems. But if the risk management function is not independent, then you have a problem. But regulators do have the power to go to the bank management and tell them what to do or not to do, and they do that all the time. Let's see. All right. Fenton says finds irony in the fact that Mr. Frank, who is involved in the Dodd-Frank Act, was on the board of Signature Bank, and that's noted. I think the Barron's had an interview with Congressman Frank, a former congressman. We have an alum who works at BCG, Boston Consulting Group, and has a question for Didier. What is the biggest challenge to you as head of ERM now?
Well, it's a big question as well, but here I would say it's not unconnected to the debate of today. It's valuable for anyone who wants to do enterprise risk management. It's not to miss a piece. Actually, if you just look at the usual stuff, let's say credit and market, and you miss, I don't know, you miss compliance risk, or here you miss interest rate in the banking book, or you miss liquidity, well, you're going to die exactly by what you're missing. So so it can be relatively easy. For example, liquidity, you always have like well-established liquidity risk management groups. Then you go to more exotic risks, and I guarantee they can kill banks as well. So I'd quote a few of them: reputational risk, which is often not very well managed by banks from what I've seen. And the one that I find too bad that often is not well managed is strategic risk. So the fact that you can actually miss your revenues and costs and scarce resource objectives because for many reasons your strategy is not adequate and so on. And actually, if you go to Credit Suisse, they were dying of strategic risk after a number of mistakes, but they didn't die of Archegos, they didn't die of Greensill, all that credit risk they took. They died because clients were going away and their revenues were falling, and no one believed in their ability to generate revenues in future anymore, and so they had to merge into someone else. So, and is that mature? Is the risk management division always assessing as they should the risks that strategy may fail? For which reasons? How certainly would it succeed or fail? I'm not sure. It's something that needs to be a lot developed. So my main thing as an ERM is to make sure that we don't over-concentrate on some parts and forget the rest, but that we pay attention to every type of risk and to their connections one-to-one. Just one thing, SVB died of not liquidity risk alone or interest rate risk alone. It died of both coming together.
All right. You had the last word, Didier. Thank you so much. It's 5:30. And I want to thank the panelists for doing such a great job today. And I want to thank the audience for being here. And it's time for me to say goodbye to everyone. Take care.